Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying the show, do me a quick favor, leave us that rating and review. And if you haven't done so already, or if this is your first time listening, be sure to hit that subscribe button so you don't miss an episode. Now, we've got a great show today. We're going to be talking to Toby Mathis. Toby Mathis advances his clients' interests by combining expert tax advice with his personal experiences investing in over 200 real estate projects. Now, his expertise reaches many others through his award-winning publications, including Tax-Wise Business Ownership and Infinity Investing. Now, Toby continues his crusade daily to help investors and business owners preserve their wealth, protect it from lawyers, snoops, and Uncle Sam to create an amazing legacy for future generations. Let's welcome to the show, Toby Mathis.
Hey, John, thanks for having me. That was a really nice intro. That's pretty cool. Thank you.
Absolutely. Well, listen, I didn't write it, so I can read and I'll take credit for that, I guess. But great background. I went over it at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, I'll make it real simple. I'm a tax attorney that got into law not to be an attorney, but because I had a mentor that didn't like dealing with lawyers. And so he sent his kid and me to law school and said, you guys got to figure this stuff out so that we don't have so many deal killers out there. So even though I'm an attorney, I'm an investor, I have over 300 properties, enjoy this space, love helping other people keep more. And a lot of people don't realize all the rules that are out there that are designed to actually help them. And they leave it on the sideline and they don't realize that they could be actually putting a lot more money in their pocket if they just knew some of the nuances.
Man, well, listen, we're going to spend the rest of this episode talking about some of those strategies. And I love the fact that you mentioned that, yes, you are a lawyer, but you're really an investor first. And you can hear a little bit of that in the bio, right? You talk about the lawyers, the snoops, Uncle Sam, right? All these people who are kind of take a little bit of that cookie out of your pocket there. But let's start there, right? So you mentioned just some of the different tax strategies that can help you. What are some of the more common ones or the common mistakes you see people making?
Well, I do the 10,000 foot view and they don't understand the different types of income. And there's really three types. There's active income when you're working hard and they hit you with ordinary tax brackets and they hit you with this wonderful thing called Social Security and they just crack you with it. And actually, believe it or not, employment taxes usually exceed federal income taxes as far as collection for our government. So it's like, if that by itself should tell you, hey, those employment taxes, maybe we should avoid them, but they're only on the active income. Then you have portfolio income and passive, and those get confused. Everybody says, I want passive income. I want dividends. But dividends are actually portfolio income. They're taxed as long-term capital gains if they're qualified dividends, and they're fantastic. But the government really wants you in that passive realm, real estate. There's nothing quite like it because real estate, I'll do a contrast. If you go out and buy a share of Microsoft, the government doesn't get you a deduction for doing that. I can't depreciate my share in Microsoft, but if I go out and buy a piece of a syndication, there's a good chance that I'm going to get a tax deduction as a result. It's going to be passive depending on the type of activity I'm investing in. Let's say it's an apartment building. It's going to be passive. If it's residential rents, it's going to be passive. Or if it's commercial, it's going to be passive. If it's generating rents, it's generally going to be considered a passive activity. There's some exceptions to that, but generally that's going to be what it is. And then you just have to know what are the differences between passive income and portfolio and active income. So without making a word salad, it really comes down to this, that my passive income can be offset with passive losses. My active income needs to have some ordinary losses. So if I have passive losses, it's not going to affect my W-2 job. And there's a couple of exceptions there, but that's the general rule. So then the question most people should be asking themselves is, well, how do I take advantage of passive losses and passive income? Like if they offset each other, then shouldn't I have more passive income? Yeah, exactly. And that's what the really rich folks realize is they end up being silent partners in things because it's not just rents that are passive, but any business that you don't materially participate in, when it starts kicking you income is passive. So if I don't work, if I, like you and I, John, we set up a pizza shop and you flip the pizzas and I don't, that activity is active for you and it's passive for me. Well, if I have a bunch of rental properties that are kicking down some passive losses, and I'll explain how that goes on in a second, that means that my pizza income, I don't have to pay tax on. huh, who would have thunk it, right? And so then you start realizing, wait a second, maybe I need to have more passive activities if I have a bunch of passive losses. So when you get into the higher end investors, a lot of times that's what they're looking for. They don't want to be an active investor in things. And quite often they'll set themselves up deliberately to make sure that they have other passive income sources because they know, as we'll cover here in a second, that you can get massive losses by investing in real estate. And when I say losses, you don't lose money, you have cash flow. But from a tax standpoint, it shows up as a loss on your return and can actually offset all your other income.
Yeah, I think there's some great strategies, and the way you broke it down, I think is really important for people to understand, right? The ordinary income, portfolio income, and passive income. And we've talked a lot about, active income and passive income, not as much about portfolio, but the points you're making here is that with these passive income, rental properties in particular, you get passive income, but you also get passive losses, and you can combine that with other passive income deals as well. So let's say you are a real estate investor and maybe you've got a couple of rental properties or you have some other investments that are passive. You can take the passive losses from deals like syndication deals and apply that across that passive income to reduce your tax obligation. So really, really important strategies to understand how it all comes together. Now, for people who maybe don't quite understand the difference between portfolio and passive, can you very quickly just elaborate that point? Because you mentioned portfolio as dividends, but what's the difference between portfolio and passive income? Because you're right. I think a lot of people say passive and maybe they mean just anything that they're not active in.
Yeah. So portfolio income is royalties, interest, capital gains, and dividends. And so there's actually different types of tax treatment, or, most of that is ordinary income, but none of it is going to be subject to self-employment taxes, which is Social Security, FICA, whatever you want to call it, old age disability survivors benefits, and Medicare, right? There's none of it is subject to that. So portfolio income is great, but depending on the type of income, if it's capital gains, for example, then it could fall in two categories. It could be taxed at your ordinary bracket if you held it less than a year. This is a general statement. There's things like futures contracts where there's ratios, but for most part, most people are dealing with, hey, did I sell some stock or a piece of real estate and only hold it for 9 months? Okay, that's going to be ordinary income. It's going to go into your highest level of tax. Or did I hold it for a year or more? In which case it's taxed as long-term capital gains. And here's what people don't realize. Long-term capital gains can be taxed at zero. If you're a married couple and you're making less than about $88,000 a year, your capital gains rate for long-term capital gains is zero, which means dividends are tax-free, which means if you sell stock, it's tax-free. And it always astounds me. I find people they're making in their retirement $50,000 a year, and they have all these unrealized gains. And they're like, well, I don't need to sell it yet. I'm like, sell it and buy it back. Oh, but then I'd have to pay tax on it. No, you have $30,000 that you could sell and not pay tax on. And now you reset the basis of the stock, so you never have to worry about paying gain on that. Plus, it makes you look like you make more money if you're trying to finance anything. And it's always kind of astounding that they go, huh? Their advisors go, And then usually they try to find a reason why you can't do that. Oh, there's the wash sale rule. Well, it's called the wash sale loss rule. You can't just churn stocks to make losses and buy them back, but you certainly can churn stocks to make gain and buy them back. And I don't see why you wouldn't. And, once you start realizing that there's things like that out there, same thing like passive income, there's passive losses offset passive income. Capital losses offset capital gains. They don't offset our ordinary income except for $3,000 a year. So when you see people like this last year where the market was down and they sell, they don't get a tax benefit unless you're harvesting some gain at the same time. And I'll use this as an example, John. We have people that made a lot of money in the stock market, and when the market started to crash, they sold and they took their gain off the table. At the same time, they're holding on to Bitcoin that they bought at a higher price, and now Bitcoin crashes and they're like, I have all these losses. You're like, yes, sell the Bitcoin, buy it back. Harvest that loss so you don't have to pay tax on the gain. If there was one thing, it's that people don't know how to match up their income and their losses. On the passive side, there's only two types of passive income. It's rents, or it's businesses that I do not materially participate in, the income from those businesses that are not dividends. Dividends are corporations paying out profits after paying tax at the corporate level. when you're like, let's say you're an S corp partnership, it's kicking some regular business. You're running a pizza shop again, and you're not materially participating. You're not working in it. You're not spending at least 500 hours a year in that business. It's going to be passive. And so all of a sudden I'm like, hey, I can match that. Hey, I have some income coming in here because cousin Al opened up a restaurant, or I helped him do the landscape business, or whatever it is. And I have all this rental property that I could harvesting more passive loss. And you can actually accelerate your passive losses on real estate. Like, it's kind of bizarre, but I could say, let's say you bought an apartment building. There's this thing called straight line depreciation, which is actually something you're not supposed to do on residential real estate, but they'll let you do it. And you say, hey, I'll take that, the value of the structure, not the land, just the structure, the box on the land. I get to write that off over 27 and a half years. Okay, so the IRS says I can do that, and that's what 99% of the accountants do. That's actually an impermissible method. And the reason being is because when you walk into that apartment building, what's the first thing you notice? I smell brand new carpeting, new paint on the walls. They put in a bunch of new cabinets. This is beautiful. I walk into a unit and I see new appliances. I see that they put new linoleum in some of it. Maybe you put some tile down. Maybe you put some carpeting down. You know, and they made a nice common area with a bunch of trees, and they put some nice decking in and all that. An accountant who knows what they're doing looks at that and says, yeah, that carpet's 5-year property. You should be writing it off in 5 years, not 27 and a half years. Yeah, those cabinets and the appliances, that's 5 and 7 year property. We should be writing that off a lot faster. When you look at the deck, you're like, that's 15-year land improvements or whatever it is. Like, it's all a shorter period of time, which means I get a deduction that much faster. And then to add injury to insult, there's this thing called bonus depreciation. You could just choose to, last year we could write off 100% of anything that was less than 20 years or less. We could write it all off in year one, making these huge passive losses. And then the accountants are like, well, you can't use that. Well, hold on for a second. Yeah, I just need more passive income. And that's where you get a tax appetite. I have passive loss. I invest in a syndication, doing an apartment complex, and it's going to kick me $100,000 passive loss. I should be immediately thinking to myself, do I have any passive income lying around? Or do I fall under one of the two exceptions to the passive income rules?
Yeah, let's pause there real quick, because you just gave a lot of great information, right? First of all, understanding the difference between portfolio and passive income.
Mm-hmm.
Portfolio income, these are going to be like dividends that you're getting, royalties, things like that you're receiving, right? And you mentioned there's the capital gains, which is if you have it for a year or less, or a year or more. And you said something I don't think a lot of people understood, and it's that if you have an income of $88,000 or less, that you actually don't have to pay capital gains on these portfolio income. And I think that's really interesting. I don't know how many people know that, but that's a really interesting fact. And that could be the kind of thing that allows people to create and save more money, as opposed to, paying more in taxes. So really great insight there. And then you started talking about the on the passive income side, recognizing that the way you're able to depreciate these assets, it can certainly stack up. And any investors in our syndication deals know, you'll get these paper losses, which is great, but you definitely have to have the passive income on the other side to balance that. And there are some exceptions, but in your the way you described it, you said there's really two options. One is you get passive income either through rentals or through some sort of business ownership or business investments where you are not primarily involved in the active capacity. Talk to us a little bit more about both kind of that aspect of it as far as generating more passive income, as well as those exceptions to the rule.
Yeah. All right. So the easiest way to think about this is if I have a tax appetite, if I have passive losses, I don't lose them, by the way, if I can't use them. So if I'm a W-2 wage earner, let's say that I'm a doctor and I make a really good salary. Let's say I'm making $500,000 a year and I have $100,000 passive loss that I get on a K-1 from a syndication, because the syndicator knows to do cost segregation and bonus depreciates the heck out of it and just goes, here's a bunch of loss. You don't get to use the $100,000 loss against your W-2 income. there's a possibility if you or your spouse qualifies as a real estate professional and you aggregate all your rental activities, then perhaps we could unlock it as ordinary, but that's the exception to the rule. That's a real estate professional. That's somebody who's married to a real estate agent or somebody who's really managing their properties and doing it themselves. But for the most part, that $100,000 is going to sit on your return as a passive loss carry forward. And you're going to get really mad because you're going to see it and your accountant doesn't really do a good job of explaining what it is. Hey, it just means that I have $100,000 of loss. That means if I make $100,000 of income from passive activities, I don't have to pay tax on. It just sits there and waits. There's two ways to use it. I have passive income and it offsets it. Or when you sell the syndication and it closes, it releases its passive losses and makes it ordinary. And then here's the more fun stuff. It's ordinary loss, which means you can use it against your W-2 income. Most people will use it to offset the capital gains from the syndication. It's like, no. Long-term capital gains are the worst case scenario is it's 20% plus the net investment income tax of 3.8. So worst case scenario, it's 23.8. Worst case for your income is 37%. I think I want to offset, use that ordinary loss against the highest income source, the highest taxed income source. But it gets unlocked when you dispose of the activity. So let's, so here's the two ways you end up using
it. And Toby,
it.
just to be clear, you're talking about once you sell that asset. Now, this is for the LP, that passive investor. You're saying it can be unlocked as to go against the ordinary income at that point?
Yep. So when you dispose of an activity, it releases the loss and it makes it ordinary loss. So whenever you're carrying forward passive losses, you're either making passive income and use it against that, or when you dispose of substantially all the activity, it releases the activity and makes it ordinary loss. And yeah, I could use it against anything. It's ordinary loss. I could use it to offset W-2 income. I could use it to offset capital gains if I wanted to. Not the best use of it, but I could. So you're looking at that. And then this is where it gets even weirder. And I guarantee you most accountants don't know this. If you have capital gain from a passive activity, it's actually considered passive. And if you have other passive losses, it'll offset that capital gain. So a lot of people exiting syndications don't realize that they have a strong appetite to go buy another syndication because you can take that big loss and offset the income from the first. The loss that was released from the first activity, you can use against your W-2 income. And you're starting to do this little shifting game. And so in the accounting world, people that know real estate, they always say, if you don't want to pay taxes, buy more real estate. Here's a situation where you have a strong appetite to continue to invest in real estate because of the tax, the tax treatment. A lot of people don't realize you're playing a little bit of a game here. It's no different than Monopoly. It's no different than any game. You just have to know the rules. And if you don't know the rules, good chance you're not going to win.
Yeah, I think your point there is really, really important because so many people don't understand those nuances. And accountants, I mean, these are tax professionals that you trust. And if they don't know, how's the average investor going to understand this information? So that's the tricky part here. And you can hear things from people. And if this is not their lane, maybe you're going to get some pushback and say, oh, you can't do that. And I'm sure a lot of our listeners have talked to their CPAs and their accountants, and they've put their financials in front of them, and maybe they have made those mistakes where they've taken those passive losses and applied against the passive income as opposed to the ordinary income. So elaborate. I want to give you a scenario just to make sure everyone's following this the right way, right? So let's say there's a syndication deal. You're in it for 5 years. You've got, the bonus depreciation. They've done the K1 losses. So you've had this K1 loss that's carried forward for a few years. They sell the asset at a profit. So you're going to get the capital, the cash from the sale of that asset. So when it comes time for the next K1, that passive or the passive loss that is now released, as you said. But there's also the income from the sale. So does it have to balance off that income from the sale first, or do you simply take that passive income and move it somewhere else?
Yeah, it doesn't. You can just use it however you want. So you have two things triggering, and this is where accountants' heads are going to explode. It's actually
Not
passive.
just accountants. You might have a lot of investors that explode too.
It's weird. And you can go verify this. Like I always say, do your independent research, but there's actually a really good Journal of Accountancy article written on it. Yeah, it's passive capital gain. That's going to trip people out. Like there's no such thing as passive capital gain. Actually, the nature of the activity maintains itself when it passes through the syndication. So if you're sitting there and you're a passive investor and you get capital gains, technically you have passive income. And then you can go get some other passive losses and offset it. Or in the loss, the passive loss carry forward gets releases. Boom, it's released. Now it's ordinary loss. And you can go take it and use it against any other income. So yeah, just knowing a couple of those things could be helpful when you're, because you're probably not going to 1031 out of a syndication. The whole syndication would have to agree to trade. So you're going to have a capital gain event. Don't be afraid of it. Embrace it. It's actually, again, that's portfolio income. It's not bad. It's way better than active income. The worst type of income you can have is going to go work at McDonald's, right? Go flip some burgers because you're going to get paid squat and you're going to get taxed a lot, right? So you're going to get hit with the federal income taxes, state income taxes, old age disability survivors, Medicare. They're hitting you with all these different taxes and you're going to have nothing left when it's said and done. Worst case scenarios in capital gains is you have a tax liability at the end of the year, right? And you're looking at it going, oh, and it's half of what it would normally be. So you're like, oh, because capital gains, we said the 0%, but then the next big leg is 15%, right? So, and I use married filing jointly. So if you're a single person and you're thinking you can do 88, it's not quite that, it's half of that. But you get these huge chunks of money that you can make. I can make $100,000, $200,000 and in capital gains, and I might be taxed at 15% on some of it and zero at a bunch of it, right? So capital gains are great. The old adage is that the rich buy assets, let them appreciate, borrow against them, and then die and pay zero tax. That's true. Capital assets, you let them appreciate. When you're doing a syndication, there's usually an exit. So there's a 5-year, 4-year, whatever it is, exit. And there's still some things you can do to make sure you don't pay tax. And it usually involves, hey, I need to buy more real estate when I'm going to have a taxable event. Okay. Maybe I have a bunch of rental properties. So like me, I have a ton of single families, hundreds of them, and they kick off a lot of cash flow. So my appetite is usually to go find some expensive leveraged real estate that's going to create a big loss. So I don't have to pay tax on any of my rental income. So if I make $200,000 a year, I pay zero. I'm okay with that. I wouldn't say I say zero on the rental income. I have other income sources. I would never say to somebody you want to be at zero because there's the 10% tax bracket, the 12% tax bracket. Like there's really low tax brackets. And it's helpful from a tax standpoint. If you don't want to get audited, you probably want to be around $100,000 to $200,000. It's a really, really low audit rate, like 0.01. It's really fractional. So you want to have some income. The people that get audited in this country, the earned income tax credit, they're about 800% more likely to get audited than the millionaire. And I'm not kidding. Like if you want to get audited in this country, be a sole proprietor making 100 grand or be poor. And chances of your audits go, 1,600% higher in the case of the sole proprietorship. You don't want to get audited? Great. Keep modest income. Keep between 200 and 500 is kind of the sweet spot. You'll probably never get a notice. It's really, really, really low. And part of it is because once you're at that level, they know you're getting an accountant. Yeah. And you get over $1 million, it's rare air. The audit rate starts to creep up a little bit, but it's still way lower than everybody else. In fact, Syracuse University did a study and they found that the lowest income taxpayers are 5 times more likely to get audited than everybody else combined.
Wow.
It's not even close. So I'd say don't be zero. Like that's being pretty crazy, right? If you have some income, if you want to get loans, you kind of need that income, but targeting zero is not necessarily realistic. You could get there, but I would say target probably 100, 200,000 and you're good.
There you go. Great insights right there. And again, I love your point too about, hey, this information is out there. You can find it, you can verify it, but also make sure you're taking this to your accountant team because that's part of it is making sure that you all are aligned with the strategy, understanding what your goals and objectives are, so that you can reach the outcome you're looking for. Let's talk about that, right? Because as we're recording this, tax season is right here. We're in the midst of it right now. And it's a little too late to do some moves that you needed to do in the previous tax year, but there's still things you can do, and takes different strategies to be effective. What are some of those things?
Well, the easy ones, the low-lying fruit, or if you're coming up upon the April 15th deadline, for example, is contributing to your IRA, doing an HSA, things like that. The big stuff where you take big chunks of money off the table is if you're self-employed, you have a defined benefit plan, or you have an S Corp that has a 401k, solo 401k. The employer contributions, which can be hundreds of thousands of dollars in the case of DB plans, can be made before the tax return is filed, plus extensions. So we could be talking, you could be making tax moves all the way into September. And then on the individual side, on real estate, you can make a change of accounting election and accelerate depreciation and make a big loss all the way up until you file your tax return in October. So even though the tax season, and a lot of it's in the past, I can't do anything, it's 2022 is over. No, that's not necessarily the case. There's a lot of things. So I've seen the over and over again every year. It's hundreds of people at our firm. Like, we do a little over 10,000 returns a year. There's about 500 of us in my firm, and this is kind of our sweet spot. Hundreds of people we're doing cost seg studies for to break down the 5, 7, 15-year property. We're doing those in October. Like, you're going to make the change of a accounting election so that let's say that during the summer you start to realize, oh crap, I had a bunch of investments and I made positive money and it's going into the highest bracket. I'm sitting here and you're hitting the 30% plus tax brackets, and you're not feeling so good about it, right? You're just realizing that you're going to have a big tax bill and you're frustrated. Okay, maybe we accelerate some of your depreciation and wipe out that tax bill. There's nothing wrong with it. I do this because, again, we have hundreds of properties. Sometimes you have a year where you're like, oops, there's a bunch of profit sitting there, paper, right? I have this income. All right, I'll go cost seg one of my buildings. Okay. Wipes out that income. You don't have to pay tax on it. You're just accelerating the depreciation. In English, you're taking a bigger deduction based on your investment. Even if you financed it, you can do this. And I'm just going to take a bigger deduction now. It's no different than when you hear people buying a car before the end of the year so that they can offset their income. It's no different than that. I'm just choosing to treat the real estate that I purchase as its components rather than treating it as one box at 27 and a half years. I'm treating it as its pieces. And invariably, you're going to have accountants say, well, the recapture is higher. Actually, it's not. In our experience, that the carpeting, if it's 5-year property and you sell in 5 years, you don't pay recapture on the carpet. It's zero because it's been written off. It has no more useful life. What you end up with is that's treated as capital gains. And we all know now that capital gains is really good tax treatment. It's better than the recapture at 25%. So you can't hurt yourself. It's actually a really good scenario. And by the way, this is how freakish it is. Let's say you sold something last year in 2022. Do you know that you could still go back and cost seg that property even though you don't own it? If it's going to put money in your pocket, you can do it. And I'll give you one example. Client had a warehouse. I think they bought it. The improvement value on the purchase was 2.5, and the improvement value on the exit was 3.3. There's about $800,000 of profit. We went back and cost segged it after the sale. The net savings to the client was $78,000.
Wow.
So you can do that after the fact if you know the rules and you look at it and say, all right, this makes sense. They held it for about 5 years. This made sense. There's a big chunk of it that was 5-year property. Yeah, we're much better off rather than having to recapture that, which that doesn't make any sense. Why would, you owned a piece of real estate for 20 years and you got to pay tax on the carpet because you recapture the depreciation you took? That's silly, right? The carpet's not worth anything. Why would you pay recapture? It's zero. That's the way you should be doing it. But again, the IRS lets us do that 27 and a half years. It's kind of like they'll let you hit your thumb with a hammer all day long. If you want to do it, they'll say, yeah, go ahead. You're not supposed to do that, but you can do it if you want.
Yeah, it's great insight, Toby. I really appreciate you helping us understand what some of these moves are, and even if you've sold a property, there still could be some plays that you can make to save and reduce your tax liability. I think the big thing for us is you have to have the right people on your team, and you talked about some accountants. This is gonna kind of go over their head, or they're gonna really have a hard time understanding some of these concepts, and maybe have to dig and do a little bit more research on this. How do you go about finding the right people as an investor? What should we be looking for? What questions should we be asking our tax accountant or our tax strategist to make sure that they're well equipped to be our partner to help us optimize kind of our tax situation?
The easiest thing to do is to say, do you invest in real estate? Do you do syndicate? If you do syndications, you ask your accountant, do you do syndications? And if the answer is, I have clients that do it, chances are you're going to have somebody that's going to have a cursory knowledge of it. And I'm not being mean. And you might, I always get a little bit of hate mail when I say stuff like this, but you really want somebody that does what you do. If you're in retail, for example, you really need somebody that understands that segment. Either they've been doing it for their whole career and they have a ton of experience and that's what they do, or they've done it themselves. In real estate, I just haven't found a replacement for somebody who does it themselves. There's too many nuances, and it's too easy to get lost in the tax code. It's tens of thousands of pages, millions of pages of interpretation. When you look at the regs and the courts, nobody really knows it. So you got to have somebody that's been there down the paths that they're going to guide you down. And the only way they're going to know whether that's a good path or not is if they've walked it themselves. So I tend to say, do you do syndications? Do you invest in real estate? Do you do it on your return? And if the answer is in the affirmative, then that's probably somebody that's good to work with. It's not a guarantee. The other thing you do is learn a little bit, not more than just watching a podcast, but, go through a class here. Realistically, you can be pretty proficient in something in about 20 hours. So I would say, start reading a little bit, maybe take a tax class here or there. There's lots of stuff out there. Our firm does it. My YouTube channel is wide open. You can go in there and start learning this stuff. And after a while, you start getting the vernacular and you start getting the pieces. And that way, when you're talking to an accountant, you could say, what did you do with my passive losses? Can you explain what happened to them? And they're going to show you the form. It's like, I think 4767, I forget what the form is, but they have the form and they might show it and say, here's where we released it. And this is what we did with it. All right, good. Now you know. Right. And you knew the question to ask and you got an affirmative response that made you feel good. And you're like, yeah, whoops. Hope that makes sense. There we go.
Yeah, no, absolutely. And I think that's just great intel, right? One, find people who do what it is you do, right? If they understand your investing strategy, they have that experience, they do it themselves, they will understand how to navigate the tax code better than someone who doesn't know it or isn't familiar. It's not a guarantee that they're going to be perfect at it, but that gives you a good chance to find someone who is knowledgeable about that space. And then making sure you yourself spend some time just learning about this. Now, most of us don't want to be accountants ourselves, so we don't want to spend too much time digging into this, but taking a class, reading some books, watching some of the videos, those are different things that can give you the cursory level of knowledge you need to at least ask the right questions to your financial investment team. With that said, Toby, I know you've got a lot of great content on your YouTube channel. If you want to check that out, just go to YouTube and search Toby Mathis, and some of his videos will come up and you can subscribe and check out some of that content there. This is great information. And as you're working on your own taxes, be sure to check out some of this and gain that knowledge so that you can optimize your own returns. Toby, we're going to switch and go to our round of insights. Are you ready?
I'm ready.
All right. Give me a failure or an apparent failure that sets you up for later success.
Oh boy. Getting my butt handed to me the first few years in practice, I hung my shingle out and it ate my lunch. And you know what? It sets the stage. When you're down, there's only one direction you can go, and it certainly helped out. And plus, I know what it feels like.
Yeah. Give me a digital or mobile resource you recommend for your business.
I would get Mile IQ, so it tracks where you drive, so you can write off your mileage. It's pretty. It's going to, because of inflation, that mileage reimbursement rate. You need to be getting yourself some mileage reimbursement if you're driving for business.
There we go. All right, give me the book you've recommended or gifted the most in the last year.
I'm cheating because I have Infinity Investing that I wrote, and I hand that out like candy.
All right, we'll make sure we link to that in the show notes there. All right, give me a daily habit that helps you stay focused on your goals.
Reading. If you're not reading, you're not exercising your mind. You need to do a little bit of exercise every day to exercise your body. You need to be exercising that mind too. So I would say that become interested in areas and then be a prolific reader in that area.
All right, you're a real estate investor as well as a tax strategist there. So give me your number one insight for succeeding as a real estate investor.
Patience. Take your right hand and stuff it underneath your right butt cheek. Take that left hand and stuff it underneath that left butt cheek and let your assets do the work. Quit being that guy or that gal that's trying to make $1 million this year, and is impatient. Learn patience and allowing the real estate to do, or the asset, better yet, any asset that you have, let it do what it's designed to do and be patient.
There we go. All right, let's lighten the mood. I know that you are based in Vegas primarily. Give me your favorite place to grab a bite to eat.
Oh, you're going to have to go do you're either going to be doing the Peppermill or Piero's. Either one, both of them were in the movie Casino. The Peppermill, you're going to be waiting a little bit for a breakfast, but if you like entertaining visuals, you go there on a weeknight, like at 2 a.m. and just watch what's coming through the door. It's absolutely all the party scene shows up, and it's a lot of fun. But Vegas has too many things to just single it out. But if you're going to do something like that, like great place to go watch people. But if you want a really great meal, that's old Vegas. Go to Piero's.
There we go. Some great options right there. Appreciate that. Well, Toby, listen, you gave us a lot of great information on some tax strategies, breaking down really the difference between active income, portfolio income, as well as passive income, and some insights on how to take different losses, your passive losses, and apply them to not just the passive income, but if a property is sold, you can actually apply that against the ordinary income. So that may be new insights that some of our listeners may not be aware of. And again, I implore you to check this information out, sit down, talk to your own accountant and get that knowledge. And also just making sure that people are taking the time to educate themselves so they can ask the right questions to their team and making sure they have the right team members on board in the first place. Again, a great place to start is your YouTube channel, and you can search Toby Mathis there on YouTube. And we just want to thank you again for coming on the show today, being a great guest, and we look forward to staying in touch. Thanks, Toby.
Thanks, John.